Let me ask you something. With over 40,000 public companies listed across global stock markets, how are you supposed to pick just one to invest in? Are you supposed to guess, follow a Reddit post, or buy whatever stock your favorite influencer just tweeted about? Look, if you're serious about building wealth, that can't be your strategy. Warren Buffett, the GOAT of investing, once said, "You can't buy what's popular and do well," and he's right. Because if you're buying what's hot and trending, chances are you're already too late. But here's the good news. You don't need an MBA. You don't need 10 screens and a Wall Street internship. All you need is a system. A simple, repeatable way to screen for quality stocks using data, not drama. So in this video, I'm going to show you exactly how I research stocks, step by step. The same method I've used for years that helps me avoid hype and focus on real opportunity. Stick with me, because by the end of this video, you'll know how to research stocks for yourself. But before we get into how to screen stocks and find hidden gems, let's take 60 seconds to make sure we understand what a stock actually is. Because if you don't know what you're buying, how can you possibly know if it's worth it? What are stocks, and why do they matter? Have you ever thought about what you're actually buying when you invest in a stock? It's not just a number on a screen. And it's definitely not a lottery ticket. When you buy a stock, you're buying a piece of a real business. That means you're becoming a part owner of that company, even if it's just a small slice. If the business grows and becomes more valuable, your stock should grow in value too. But here's the thing. Stock prices don't always follow logic. They move up and down based on supply and demand. If more people want to buy the stock, the price goes up. If more people want to sell, it drops. So it's not just about how much profit a company is making right now. It's also about what people think it'll make in the future. That's why a tech startup with no profit can be priced higher than an old company making billions. Investors are buying not just what is, but what could be. At the end of the day, people invest in stocks because they want to build long-term wealth by owning real businesses. Whether it's for retirement, a home, or just financial freedom, the goal isn't to gamble or guess, but to participate in the growth of the economy. Now that you know what stocks really are and why they matter, let's talk about the first thing I always check before I invest. Is the stock cheap or is it expensive? Let me show you how to tell. Step 1, valuation. Is it cheap or expensive? Let me ask you something. Would you buy a Ferrari without knowing the price? Exactly, probably not. Because no matter how good it looks, price matters. And one of the simplest ways to check that is to look at a metric called the PE ratio, price to earnings. It tells you how many dollars you're paying for each dollar the company earns. If a company has a PE of 10, you're paying $10 for every $1 of earnings. If it has a PE of 50, you're paying $50 for that same $1. Now, is that bad? Not necessarily. It depends on the business, the industry, and the growth potential. But generally speaking, the lower the PE, the cheaper the stock. Another metric I really like is EV/EBIT. That's enterprise value divided by earnings before interest and taxes. Let me break that down quickly. Enterprise value is kind of like the total price tag of the company, not just its market cap, but including debt too. EBIT is the company's operating profit, how much it earns before paying interest and taxes. EV/EBIT tells you how many dollars you're paying for every dollar of operating profit, and it's especially useful when comparing companies with different capital structures. Legendary investor Howard Marks once said, "There's no such thing as a good or bad idea, regardless of price." And he's right. Even a great company can be a bad investment if you overpay for it. But here's the thing. Just because the stock is cheap doesn't mean it's good. A company can be cheap for a reason. If it's losing money or stuck in decline, that low price might be a red flag, not a bargain. So in step 2, we're going to ask, is this company actually making good money? Let's look at profitability and why it's your next big filter. Step 2, profitability. Is the company making good money? Let me ask you something. If you bought a restaurant for $2 million and made $200,000 in profit each year, is that a good deal? Now, compare that to someone else who spent $4 million to open a different restaurant, but also makes $200,000 in profit. Same profit, different price tag. Which one would you rather own? Exactly. The one that gives you more return on your money. That's what we're looking for in the stock market. This is where return on assets or return on capital comes in. Basically, how efficiently a company turns its assets into profits. Charlie Munger, Warren Buffett's right-hand man, once said, "Over the long term, it's hard for a stock to earn a much better return than the business which underlies it earns." That means if the business only earns 5% on its capital, you're not going to make much more than that over time, even if you got a great deal buying the stock. So here's what I do. When I'm researching stocks, I like to filter for companies that have a return on assets above 10%. That's my minimum. It tells me the business is not just making money, it's doing it efficiently. Now, not every company with a high ROA is a guaranteed winner, but filtering out the low-quality ones saves you a ton of time. That way, you're only spending time on businesses that already passed the smell test. Now, just because a business is profitable today doesn't mean it'll keep growing tomorrow. That's why in the next step, we look at growth, because even the best engine needs fuel to move forward. Let me show you what to watch for. Step 3, growth. Is the business expanding? If a company made more money this year than last year, would you say that's a good sign? Probably yes, and you're not wrong. But here's the catch. Just because a company grew in the past doesn't mean it will keep growing in the future. That's what we're talking about. Searching a stock, you want to see a company that's growing, ideally in both revenue and profits. Why? Because growing companies tend to become more valuable over time, and that's how your investment grows too. But here's the warning. Some companies look great on paper until you zoom out. Take Biogen, for example, a big pharmaceutical company. Up until 2014, Biogen looked unstoppable. Revenue was climbing, profits were solid, everything looked like a winner. But suddenly, the growth stopped. And investors who bought at the top, they've been waiting years to catch up. The lesson here is simple. Don't just chase fast growth. Chase reliable growth. Look for companies that grow consistently over time. A little up and down is normal. No business grows in a straight line forever. But avoid companies that are clearly in decline. If a company's revenue or earnings have been falling for years, that's a red flag. And by the way, be careful with companies that grew super fast only once. Sometimes that spike is just a one-time event, like a stimulus boom, a viral product, or a short-term trend. If that growth isn't repeatable, your investment could suffer. So here's what I do. When I screen for growth, I like to check if revenue and profits have been trending up over 3 to 5 years, not just one. And if I see declining numbers or a company riding a one-time wave, I move on. Because your goal isn't just to find fast growers. It's to find sustainable growers. But let's say you found a company that looks like it's growing. Before you get too excited, here's a key question. Are those numbers real or is it just a fluke? Let's talk about that next. Investors, we want repeatable success, not lottery winners. So how do we check that? Here's what I do. I pull up the company's historical EBIT, which stands for earnings before interest and taxes. Don't worry about the technical name. Think of it as the company's core operating income. It tells you how much money the company makes from its actual business. Now, let's say a company earned $100 million in EBIT this year. Sounds great, right? But what if you look back and see they only made $10 million last year and they lost money the year before that? Yeah, probably not the kind of trend you want to bet your savings on. What you're looking for is consistency. Steady, reliable numbers, not some crazy spike that came out of nowhere. Let me give you a quick rule of thumb. If EBIT or net income jumps dramatically in 1 year, but the years before were flat or negative, that's a red flag. It might be a one-hit wonder, and you don't want it to be the person who buys at the peak. So, before you get too excited about a stock with great current numbers, look back 3 to 5 years and ask, is this a trend or just a lucky break? All right, so now you've narrowed it down to companies that are not only profitable and growing, but reliably so. You're doing great, and now it's time to take things a step further. Because here's the truth. A stock isn't just numbers on a screen. It's a real business. And if you're going to invest your hard-earned money, you should understand what that business actually does, who's running it, and whether it has a long-term advantage. Let's move on to step 5, deep dive, where we look under the hood and see what this company is really made of. Step 5, deep dive, understand the business itself. Do they have something special, a moat that protects them from competitors? A moat could be a strong brand like Apple, or massive scale like Amazon's warehouses, or patents like pharmaceutical companies. If there's no moat, what's stopping someone else from stealing their business next year? Then look at who's running the company. Are the executives experienced? Are they buying shares with their own money or dumping them? Insider buying is often a good sign. It means management believes in the future. But if insiders are constantly selling, that's a red flag. You can find this info in earnings calls, public filings, and even investor presentations. Most of that is available for free or much easier to digest on platforms like tkr.com. Here's a quick tip. Once I narrow down my stock list, I like to run one final screen, my personal filter. Maybe I don't want companies with high debt, so I filter out those with debt to equity above 1. Or maybe I want cash-generating machines, so I look for companies with strong free cash flow margins. The point is, once you understand what kind of investor you are, you can build your own custom checklist. Because in the end, you're not just buying a stock, you're buying a business. And that brings me to something that separates great investors from average ones. It's not just about the numbers or the filters, it's about how you think. In the next part, I want to share a few bonus tips, things that have helped me avoid hype, stay focused, and think like a real owner, not just another trader chasing the next big thing. Let's talk about that. Bonus tips: think like an owner, not a trader. Think long term, like really long term. Think in decades, not days or weeks. Warren Buffett, one of the greatest investors of all time, always says our favorite holding period is forever. Why? Because great businesses take time to grow, and the market's short-term noise just creates distractions. Same goes for Peter Lynch, who reminded us that owning stocks is owning part of a company, so you want to pick ones that can keep growing steadily over the years. Also, don't be afraid to be a little contrarian. The crowd often rushes to buy what's popular, but that's usually when prices are high. The smartest investors look for opportunities when others are skeptical or ignoring them. As the saying goes, be fearful when others are greedy, and greedy when others are fearful. Don't just follow the herd. Sometimes going your own way pays off big time. So keep that mindset, invest like an owner, not a trader chasing quick wins. Patience and discipline are your best friends here. All right, remember the 5 key tools we used. Valuation, finding stocks that aren't overpriced. Profitability, making sure the company actually makes good money. Growth, seeing if the business is expanding. Reliability, checking the numbers aren't just a one-time fluke. And finally, the deep dive, really understanding the business behind the stock. Here's the best part. You don't need to master all these steps at once. Even if you start by just focusing on valuation and profitability, you're already ahead of most investors who pick stocks based on rumors or hot tips. So take this as your game plan. Start researching with these steps, be patient, and remember, smart investing is a marathon, not a sprint. If you found this video helpful, please hit that like button, leave a comment below with any questions or stocks you want me to review. And don't forget to subscribe so you won't miss future videos where I break down investing in simple, actionable ways. Also, if you want my full stock research checklist, step-by-step and ready to use, just check the description below. I've linked it for you. Thanks for watching, and I'll see you in the next video.